What's going on, guys? Today we've got an amazing episode with Darius Dale, the founder and CEO of 42 Macro. We talk tariffs. What's going on with risk assets? Was it a mistake? What's going to happen next? And Darius, he lays it on. Is this the blue collar industry versus Wall Street? Who's going to win? We got it all covered today. Here's my latest conversation with Darius Dale. All right, Darius, I thought the best place to start is with the main show. The Super Bowl of all of capitalism is Main Street versus the blue collar businesses. This feels like all my friends in finance, they hate tariffs. They think this is the dumbest policy they've ever heard of. A lot of the people I know in the industrial manufacturing industry, they're pretty excited about it. There was a guy from Marlin Steel. He's a CEO. He was on the floor of the factory on CNN holding up a basket saying Trump is going to level the playing field. And he seemed really excited. What is going on here? Why are there two different factions?
Yeah, great question, man. Thanks for having me as always. Great to be here, especially during such a trying time. The reason there are two factions is because we were exiting a game, a paradigm whereby the winners of the game were people who most benefited from globalization and that geopolitical world order. And we're likely headed to a paradigm where the winners of the game are the people who benefit from more regionalized, localized, factors of production. And so that's why you see this sort of debate between Wall Street and Main Street, because Wall Street exists to find profits, to find productivity, and ultimately the best way that they figured out, quite possibly in history, was globalization, right? You basically reduce the largest cost of largest input cost for most production, which is labor. You found a way to spread those costs around the world and ultimately lower costs and create a significant positive shock to corporate profits. My favorite chart, which you guys will put up while we're talking, is the chart that shows labor versus capital. It has corporate profits as a share of gross domestic income up at 14% relative to a long-term mean data back to the 40s or 50s of about 9%. And then we have labor share of national income, which is somewhere around 51, 52% compared to a long-run mean of about 56, 57%. Now, the deviations from those means doesn't sound like a lot. It's like 500 basis points. But 500 basis points effectively equates to about $1.5 trillion of lost income that's going from the household sector to corporate profits every year. That's about, let's call it 11% of the median, 13% of the median income. And it's roughly about, $11,000 per private sector employee. So basically every American household with two working people is losing about $25,000 a year as a function of globalization. And that's why the entire electoral college map was red from sea to shining sea.
Now, I agree with that. And I think that Wall Street doesn't understand it. I, for a whole different reason, have spent the last 2 years talking to a lot of people in the industrial manufacturing space. I've gone to these businesses. I've walked the factory floors. I've met the workers. I've met the CEOs, all this stuff. These people do not care if your Wall Street portfolio is going down. And people say, oh, they're 401k, all this stuff. Listen, the people who are working in these businesses, I'm not talking about the CEO who's got stocks and stuff like that. I'm talking about the people. I went to a electrical harness business in Michigan. And there's a bunch of people, and they were literally assembling electrical harnesses that go into cars and different electrical products, right? These people are sitting there assembling these products with their podcast or their music playing in their headphones. They're doing it all day long. They don't even know the stock market is going down. No. They're trying to go to work, make a living, go home, enjoy their life, and make a better life for their kids than they had for themselves. That's their goal. And so the investors, though, they do have investments. They do care about the stock market. I knew that this was going to be a very important chart because I have never seen you draw on a chart before. And when I saw the drawing, I said, my boy was in the lab cooking. So before we put this chart up, I want everyone to take that wax out of your ears, put your glasses on. If you got rec specs, with the elastic band for sports, put the rec specs on. Darius, hit us with what's going on in the risk asset chart you got here.
Yeah, look, man, thank you for saying all that, man. And by the way, I agree with you. You and I both have very humble beginnings to where we've gone to today. I think you and I understand the plight of the common man, of the folks who've been left behind by globalization much more saliently and much more real, tangibly than the average person on Wall Street, the coastal elites who comprise Wall Street and Palm Beach and San Francisco and all the stuff that's going on in Hollywood. At the end of the day, what we're trying to do is educate them as to why President Trump feels so compelled to stick with this fourth turning transition. And so that takes me right to this chart here, which is when you think about how markets behave in a quote unquote normal regime, a non-fourth turning regime where we have these massive, huge geopolitical, social, institutional changes, in a normal regime, you just have, your kind of standard bull marketed stocks. They go up, they go down as a function of the business cycle, and that's pretty much it. When we're in a fourth turning regime, you have all these very powerful forces pulling and pushing on each other, much like a sumo wrestler or offensive or defensive lineman in the trenches. There's so much force that, when the tide changes even a little bit, you have these massive melt ups and meltdowns in markets. Can I throw a stat at you, Pump? I'm going to throw two stats at you. One's going to shock you to your core. The first one won't, but the second one definitely will. The first one is every year since 2015, the market has either gone down 20% or up 20% in that calendar year. We've been living in a nuts timeline, right? Every year for the past decade, the market has either gone down 20% inch a year or up 20% inch a year. Like that's more than double what a normal market return is. And that's what we're trying to suggest is that the fiscal largesse that you tend to see as a function of populism in a fourth turning, as well as the monetary policy response to that in terms of, gobbling up bonds and trying to, force financial repression onto investors. These are the kinds of dynamics that basically cause us to go from up 20 2 years in a row to down 20 the next year, maybe up 20 a couple years in a row to down 30 or 40 the next year. This kind of very volatile setup is a function of the fourth turning and all those dynamics. And one thing I'll conclude with, go back to the folks in that manufacturing plant in Michigan that are, just trying to provide a better life for themselves and their kids and hopefully that their kids can live a better life than they did. Those people definitely don't own stocks. Did you know, Pump, that 88% of all financial assets in this country is owned by the top quintile of investors?
It's crazy.
The top 20% of human beings, of households in America, own 88% of all financial assets. That means the other 12%, we got to divide that with the 80% of us have to divide the other 12%. And so no wonder no one gives a damn about if the stock market's down because of tariffs. This is a real institutional societal shift transformation that's happening, and Wall Street is incentivized not to report it. They're incentivized to fight it. And ultimately they're incentivized to lose money because of it, because ultimately they have to lose the game in paradigm A to facilitate the transition to paradigm B.
It makes a ton of sense. You've got a slide in here talking about the journey is more important than the destination. What's that mean?
Yeah, 100%. So this one of my favorite charts I've ever created in my almost 17-year career on Global Wall Street now. This chart helps explain what I think is the most misunderstood but very important, one of the most important concepts in all of finance. The average retail investor does not understand this chart, but everyone feels this chart, especially as you get older in life. So what this chart is essentially explains the impact that volatility drag has on investor portfolios. And volatility drag is, if you look at the far right of the chart where it shows portfolio size after year 3, look at the bars. There's $338 in the blue bar and $200 in the red bar. Volatility drag is the spread between those two bars, or essentially it's the spread between those two bars as a function of the path that the assets have taken to get there. Both the red bars and the blue bars in this chart feature identical 50% average annual returns. However, you wind up with more money if you take the path that the blue bar takes, which is a more smooth ride to building wealth, as opposed to a more volatile ride for building wealth. And this is what we try to coach investors on, is that you can build wealth by participating in assets like Bitcoin. I'm a huge Bitcoiner. You're obviously a Bitcoiner. But you also need to be respectful of the fact that if you buy the asset or are overly exposed to the asset at the wrong time in the investment cycle, you will suffer volatility drag and you'll ultimately wind up with less money over a longer period, over a longer time horizon. So I think 2025 is a great year to reintroduce investors to this very important concept. Now,
asset prices are crashing and inflation was crashing. If you look at things like Trueflation, the Fed emergency rate cut odds are up like 25 to 30%. But you're saying, which still means there's not likely to do it. People forget how odds work.
What's 25 basis points going to do, Pop? Come on.
The labor market, though, you think is too robust. You think that they can't cut. Explain.
This is the problem. This has always been the problem with the Fed. They anchor on lagging indicators. The Fed only eases policy for 3 reasons. One, we have a miraculous disinflation, which almost never happens in the history of the data. So you can kind of rule that out, especially in the context of, going back to before Smoot-Hawley and tariff prices and tariff tax rates. Two, the labor market comes unglued, which the labor market is a lagging indicator. It lags the economy and the stock market by about 2 quarters. So it's too late if they're going to do that then as a function of labor market. And then there's financial stability concerns, which of course it'll be too late in market price terms, may not be too late in labor market terms. They eased policy in September of 2019 in response to financial stability concerns, and it prevented what may have prevented a recession. We wouldn't know. Obviously, COVID is a kind of factual, but it may have prevented a recession then. But the reality is we had already crashed in Q4 18 and the credit market froze up. So the reality is the Fed is I think I talked about this a few years ago in 2022, which is the Fed's like a janitor. Right? Like you don't see a janitor like sweeping the mop and broom over people's shoes when they're working or partying at the event. The Fed comes in after with all the trash on the floor and sweeps it into the dustpan and mops the floor, right? And so ultimately, as an investor, you need to be aware that, you can't be so myopically focused on the Fed to bail you out because they're usually going to be too late, is what I'm essentially trying to say. And right now, the labor market is too robust, as evidenced by non-farm payrolls growing 345,000 since Trump took office. I mean, this is a labor market. I mean, granted, you can take issue with this data, and I do take issue with this data to some degree. But even when you look at hyper high frequency data like jobless claims or some of the Indeed survey data or leading soft data, it still says that the labor market is still reasonably robust. And that's a problem for investors.
Now, the Fed, what can they do? Obviously, they're not going to cut. What are they? You and I've talked before, are they going to raise the inflation target? Or are they potentially just going to say, screw it, we messed up? They're behind the ball. They're lost in the sauce, right? Frankly, what do you do? Look. Jerome Powell's just like, I'm not going to listen to Trump. Trump's tweeting at him. What happens?
Yeah, look, I think this is why you play nice in the sandbox. And Trump's going to regret being so mean to Jay Powell over the past, 6, 7, 8 years. Jay Powell, if he was on board, would probably have already cut interest rates and probably have already signaled, hey, we are prepared to use our balance sheet to tone down volatility in financial markets. That's what a good central, I'm not even saying Jay Powell's a good or bad central banker, but I think a proactive central banker would be doing that by now, because they ultimately understand that whenever you have contractionary fiscal policy, in order to keep an equilibrium level of economic activity, you need to have equally expansionary monetary policy. And they're doing the exact opposite of that in terms of sitting on their hands and maintaining what they believe is a restrictive monetary policy setting. That's wrong, in my opinion. And you and I have talked about this slide here, our secular inflation model slide, many times over the past few years, which is our model continues to suggest that the equilibrium core PC inflation rate in the US economy is around 3%. Somewhere in the high 2s, low 3s, can't be more specific than that. But the Fed is targeting a 2% inflation target. And as long as they're targeting a 2% inflation target, that means they're sort of forced to sit on their hands and keep monetary policy, at least according to their metrics, restrictive until they feel very confident that inflation is going to return to 2%. And based on our model, if the equilibrium inflation rate is 3% or somewhere thereabouts, then the only way you're going to feel very confident about that is in a significant breakdown in the labor market. And what I'm trying to argue is if they just acknowledge the fact that the inflation is running hotter in this business cycle, we wouldn't have to suffer through all that needless job loss as a function of the policy mistake they're currently making.
Do you think that they can get back on the ball? Like, is it possible for them to catch up? Today's episode is brought to you by Consensus. They're the world's longest running and most influential gathering of the global crypto, blockchain, and AI communities. Curated by CoinDesk, this prestigious annual event happens in Toronto, Canada on May 14th through the 16th, and it is set to welcome 20,000 builders, investors, policymakers, and pioneers shaping the future of the decentralized digital economy. From understanding Bitcoin's potential in a shifting regulatory landscape to the latest innovations in the digital assets and infrastructure, Consensus is your best bet to unlock market-moving intel, make meaningful connections, and get business done. You can't afford to miss it. And because you listen to this podcast and you watch this show, you get 15% off registration if you use the code POMP15. Go to CoindeskPomp.com. Again, that's CoindeskPomp.com to register now. Once again, go to CoindeskPomp.com and use code POMP15 for 15% off your Consensus Toronto tickets today. It's no secret that Bitcoin ETFs have taken Wall Street by storm. With over $35 billion in assets in just